They promised us a revolution, a decentralized future, freedom from the shackles of banks and governments. Crypto, they said, was the answer. But was it all a lie? Was the dream of a democratized financial system nothing more than a carefully crafted illusion? The truth is far more complex and far less liberating than the hype suggests. Decentralization, the supposed bedrock of crypto, promised to distribute power amongst the many. It painted a picture of a more equitable world free from the whims of centralized authorities. This seductive narrative captured hearts and minds, fueling the meteoric rise of cryptocurrencies. But as we delve deeper, cracks begin to appear in this utopian vision. The reality of power dynamics in the crypto world tells a different story, a story of concentrated control, manipulation, and unfulfilled promises. Bitcoin, the first cryptocurrency, emerged from the ashes of the 2008 financial crisis. Its mysterious creator, Satoshi Nakamoto, envisioned a peer-to-peer electronic cash system, free from government control and the vulnerabilities of centralized institutions. Early adopters, drawn to this radical vision, saw Bitcoin as a beacon of hope. It represented a break from the established financial order, a chance to rewrite the rules and build a more equitable system. But as Bitcoin gained traction, so did the attention of powerful players. Investors, drawn by the allure of astronomical returns, poured billions into the market. Technologists, captivated by the potential of blockchain, the technology underpinning Bitcoin, rushed to build their own platforms and applications. What began as a fringe movement was quickly becoming mainstream. But with this influx of capital and interest came a shift in power dynamics. The very institutions crypto sought to dismantle were now finding ways to control it. The promise of decentralization crumbles under the weight of a simple truth. In the world of crypto, not all participants are created equal. While anyone can buy a fraction of a Bitcoin, the vast majority of wealth and therefore power remains concentrated in the hands of a select few. These are the whales, individuals or institutions holding massive amounts of cryptocurrency. Their influence is undeniable. By moving large sums, they can manipulate market prices, triggering cascading effects that can wipe out smaller investors. They hold sway over governance decisions, influencing the direction of blockchain projects. The decentralized utopia, where everyone has an equal voice, feels increasingly distant. Blockchain, the technology underpinning cryptocurrencies, has been hailed as a revolutionary force poised to transform industries beyond finance. From supply chain management to healthcare, its potential applications seemed limitless. Proponents promised increased transparency, enhanced security, and reduced costs. Yet, despite the hype, real-world adoption of blockchain outside of crypto remains limited. Pilot projects have often failed to deliver on their promises, bogged down by technical challenges, regulatory hurdles, and a lack of clear use cases. Many industries have found that existing, centralized solutions are simply more efficient and cost-effective. The transformative potential of blockchain, while intriguing, remains largely unrealized. The crypto landscape is littered with the wreckage of scams, hacks, and failed projects. From elaborate Ponzi schemes to outright thefts, the allure of easy money has attracted its fair share of bad actors. The decentralized nature of crypto, while intended to empower individuals, has also made it difficult to track down perpetrators and seek justice for victims. The Mt. Gox hack, one of the most infamous incidents in crypto history, saw hundreds of thousands of Bitcoin stolen from what was then the world's largest Bitcoin exchange. This event, along with countless others, has exposed the vulnerabilities inherent in this unregulated space. These failures have not only resulted in financial losses, but have also eroded trust in the entire ecosystem. The crypto boom has undoubtedly spurred innovation, pushing the boundaries of what's possible with technology. However, it has also exposed a dangerous trend: the prioritization of hype over substance. Too many projects have been built on flimsy foundations driven by speculation and the promise of quick riches, rather than genuine utility or value. It's time to move beyond the hype cycle and focus on building technologies that solve real-world problems. We need to demand greater transparency, accountability, and ethical conduct from those building and investing in this space. Only then can we hope to realize the true potential of blockchain and create a more equitable and accessible financial future. The crypto experiment has been a valuable learning experience, albeit a costly one. It has taught us that decentralization, while a noble goal, is not a panacea. It has shown us the dangers of unchecked speculation and the importance of critical thinking. But most importantly, it has reminded us that technology is only as good as the intentions of those who wield it. The future of finance, and indeed the world, depends on our ability to harness the power of technology responsibly and ethically. We must move beyond the allure of quick riches and focus on building systems that are truly decentralized, equitable, and accessible to all. Let us not abandon the dream of a better future, but let us approach it with open eyes, critical minds, and a commitment to building something truly transformative.